while FIIs may have sold or sold marginally, DIIs have been very active buyers. What looks like the way ahead? Because typically DIIs, as we said, are value seekers as well. Has Kotak been doing that? That's the question that we ask Harsha Upadhyay, CEO, CIO of Equities at Kotak AMC, joins us right now on the show. Harsha, good morning. Thanks so much for joining in. Before we get to the
Good
markets,
morning.
Harsha, just want a sense from you. How has the flow, retail flow been into funds? Because we were speaking to Nilesh earlier, and he was saying that maybe May was a bit slow. Has June been okay? And have you been consistently deploying money in this dip that we saw in the markets?
Yes, we have been consistently getting money, although in the last 1 or 2 weeks, maybe there has been some dip, but I won't call it as a trend. But over the last several months, the money flow into mutual funds and also into Kotak equity funds in particular have been consistent, and we continue to deploy that at various levels of the market.
I would reckon that you found the intermediate fall in the markets fairly attractive. And have you bought aggressively out there, or do you believe that there will be better levels for DIIs or Kotak equity funds to buy into?
Generally, on the cash side, we do not take very aggressive calls. We limit it to about 7.5% maximum in all our funds. So to that extent, we don't build up cash level at Kotak mutual fund. But within that leeway, we have been selecting companies which are looking attractive after every volatility that's been seen in the market. So it's going to be more selective in terms of both stocks and sectors. As we find more opportunity in these volatile times, we will deploy remaining cash as well.
So what's looked attractive, Harsha, at sub 8,000? Have you massively rejigged your portfolio or merely just added more positions to what was already looking good?
It's mostly existing set of stocks which were already there in the portfolio, which have corrected quite nicely in the past few weeks. There we have built up further positions. And also within large caps, there have been several stocks which have corrected quite meaningfully. And in those stocks, we have built up some positions. We believe that at this point of time, compared to mid-cap segment, large caps do offer a better risk-reward profile, and we are looking at those opportunities.
We're marching towards 8,300 on the Nifty, and a week ago, Nifty had gone below 8,000. So the force of the comeback, I think, is quite extraordinary, and that just tells you that Indian markets are no longer dependent on foreign flows. So if you really talk about the most heartening sign is that Indian markets are no longer a one-trick pony. Foreign institutional investors are not the real price makers, and it's good to see that local crowd is now finally believing and finally really acknowledging the importance of equity as an asset class. Harsha, we've discussed this point when we started the show with you on the importance of DI flows. What's your sense? Are we potentially staring at about $8 to $10 billion of fresh inflows in FY16? Are your estimates indicating that?
FY15 was something like that. If earnings don't disappoint maybe after 1 or 2 quarters, because almost everybody on the street believes that first 1 or 2 quarters of this financial year are likely to be a little soft. And after that, if we see the earnings momentum building up, then I would say that probably the numbers that you mentioned may be possible. It all depends on how fundamentals shape up going forward. But the recent trend has been quite positive.
You have a very large exposure to autos, and within autos you are clearly backing four-wheelers. You're not backing two-wheelers. You own Maruti, you own Tata Motors. So first autos, and then within autos, why four-wheelers? Why not two-wheelers? I thought value was there with two-wheelers because two-wheeler stocks have fallen down.
Clearly, auto has been one of our preferred sectors for a long time, and we continue to believe that even in this sluggish economic growth, there are some sub-segments of auto sector which have been showing a reasonable amount of volume growth, for example, passenger cars. And this is an industry which has high operating leverage, and even a small uptick in volumes can meaningfully alter profitability. That's the reason why we have been bullish on this sector. As far as two-wheelers go, we believe that it's more rural oriented in terms of demand as compared to passenger cars. where we still have some concerns in terms of how rural consumption is going to build up. Not just because of the current monsoon season, but also because the MSP price increases over the last 2 years have been quite muted. So overall, rural income has remained under pressure, and that's one of the reasons, along with the monsoon, which is playing on our minds, and hence we continue to prefer four-wheelers to that of two-wheelers.
Well, Harsha, I've got to say you're the lucky charm on the show. Guess what? We are back at 8,300 levels. From 8,200 on Friday, it's just taken one trading session for us to actually make it to the next landmark. So there we are. Banks, you'd have to say, a very strong participant in trade today. BOB, Axis, Kotak Bank, Yes Bank. The top 5 slots on Nifty are right now within the bank spaces itself. The Bank Nifty has contributed a nice almost 2% to the rally. HDFC Bank, Yes Bank, the gains are anywhere between about almost 2 to 3% apiece. Then of course you've got ICICI Bank as well. Couple of these Tata names as well. So Tata Steel, Tata Motors, TCS, they too are powering ahead within the Nifty. But yes, banks and financials again. So HDFC, IndusInd Bank, SBI, PNB, they again are holding out very, very smartly in trade. I want to see where the big mover from last week, Reliance, is right now, and whether or not that continues to perform. No, it doesn't. It seems like the move on Reliance was pretty short-lived, and that stock is taking a bit of a breather after a very, very hefty run-up all of last week. And Bharti, ONGC, Idea, so a couple of telecoms, some IT names, they are the ones which are the laggards, besides, of course, oil and gas. Within the mid-cap universe, it's got to be infrastructure and real estate today. So Indiabulls Real Estate, a 13.6% notch up on the futures, a PNB, Wockhardt, GMR and JP Associates. These are your top performers in trade right now. But Harsha, just getting back to your list of portfolio names, it's a very concentrated bet within the pharmaceutical space, just one of the blue chip giants. Is it time now to relook at the pharma space and perhaps spread out, because there are a lot of other stocks, even mid-cap pharmaceutical companies, which are giving excellent returns right now?
Pharma, we do have more stocks than just one large cap name. Probably what you're seeing is some of the top holdings where you would probably find one stock. But clearly this sector has corrected, especially the large cap pharma segment has corrected quite meaningfully in the last few weeks. And we are looking at that as an opportunity to add some of those exposures.
Now, my question to you is, what about spaces which necessarily have only mid-cap companies in them or non-index companies but are large exporters? And ignoring a Motherson Sumi or Bharat Forge, the other auto component companies would be small caps or mid caps, but very interesting stories. We're just talking about textiles and the exporters thereof, a Kitex, a Welspun, etc. Not large cap companies, but leaders in their own sense, and fairly exciting stories here as well. Do you like any of these slightly smaller pockets in the exporters theme?
I wouldn't like to comment on individual stocks, but within exporters, we continue to favor companies which have a significant competitive advantage and which have shown over the years that they can build up exports business and be very competitive compared to other global players. So these companies come from IT, pharma, engineering, auto ancillary, some of these sectors. And irrespective of market capitalization, if we find the names to be strong in terms of competitive advantage and the fundamentals, we do buy into those names.
But okay, then my question is, I don't want you to talk stocks, Harsha, but does a small sector like textiles fit in there? Because the companies, the commentary from the managements are fairly optimistic. We just had Kitex Garments today speaking about how growth seems to be going well, and they do have a bit of competitive advantage right now compared to peers in China, Bangladesh, Philippines, etc., or Pakistan for that matter. Does that space interest you at all, or is it too small right now for your liking?
We do have some exposure to textiles, but that is not on export story. It's more to do with the individual companies' business prospects. So to that extent, we have been not so exposed to textiles as a sector. We do have only one or two names.
How do you propose one should bet on the demographic stroke consumption theme in India, because the big names HUL, Britannia, Colgate, ITC, they are extremely expensive. Consumer staples as a group is an important group, but it is coming at a lofty price. Fund managers cannot ignore the India demographics, the consumption play. But my question to you is that how does one invest when prices are looking slightly stretched?
We do have select bets within FMCG pack. We believe that as long as there is market share gain for some of those players, as long as there is margin momentum and earnings momentum, the stocks would continue to trade at higher multiples. It's not that we are betting on further re-rating of some of these stocks, but we do believe that the current valuations can hold up as long as the earnings momentum continues to be strong. So we are looking at those names selectively, and to balance that, we are also positive, as I mentioned earlier, on the urban consumption story, which can be played through autos, consumer durables, and some other discretionary names. So we are balancing overall consumption between staples as well as discretionary at this point of time.
Harsha, so good chatting with you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.